Okay. Hi, this is Pete Riley of Zorgamento Productions, LLC, and I'm your tax matters partner. And we're going to talk today about Section 183, commonly referred to as the hobby loss rule. And the title of the talk is Actually and Honestly for Profit, which is the key essence of the hobby loss rule, code section 183. This seminar will be presented in a much lengthier thing later this week, and will be available for credit from the Boston Tax Institute. So here we go. The main reason I've been a CPA for many years. I started in public accounting in 1979, became a CPA in 1983. And oddly enough, the hobby loss rules have been around for longer than my career. And I believe that there's a lot of misunderstanding among practitioners and taxpayers about them, and it causes people to be a lot less aggressive than they really should be or could be. And that's the main purpose of this seminar, is to talk about why it's reasonable to take a more aggressive approach. I write for Forbes.com and think outside the tax box. And I think a lot of times you'll find a lot of my stuff more on the conservative side, from which has a different meaning when you're talking about tax preparation, meaning more compliance oriented and trying to avoid people doing crazy stuff. It was from there that I started writing about hobby loss cases, mainly because I find them so amusing and such great stories. But over time, I realized that the focus on the losing hobby loss cases, which are sometimes hilarious, is really inappropriate. And I did a pretty massive study of hobby loss of Section 183 decisions, over 183 of them, and from that I've come up with some ideas that are a little different, but this is based on extensive reading of the case law. So let's do some of the basics though. And of course, the most basic thing is the general rule, code section 183. And it's ironic in a way that 183 is actually an allowance section. It allows a deduction. But what it also says is this is the only deduction you're going to be allowed. And essentially it's you'll be allowed a deduction to the extent of your gross income. And it's an itemized deduction, which currently under the Tax Cuts and Jobs Act of 2017 is not allowed, making the stakes in hobby loss cases even higher. The other thing to note is it doesn't say hobby loss anywhere in here. So some people are kind of pedantic and say, well, you shouldn't call it hobby loss. It's activities not engaged in for profit by individuals or an S corporation. And there's a ruling that extends this to partnerships. And in fact, Section 183 has been used against things that are not in any way hobbies, although in recent years that's been rather rare. we'll get into that a little further. So where does this all come from, though? Great year. Probably most of you out there don't remember it very well, but sex, drugs, rock and roll, to the moon, Woodstock, 1969, the Tax Reform Act of 1969, the committee report is really important reading if you're going to be fighting with an agent about the hobby loss, or to get the understanding. It replaced an older section that had been part of the 1954 code that was limited losses to $50,000 a year, and that's a lot of money now in my mind. But if you want to go back to 1969, you could use a multiple of like maybe 8 to figure it. So if Code Section 270 was still in effect, this would apply to very few people, and people were able to game it pretty easily. So it was replaced with Code Section 183. And in the committee report, there are 2 things that are emphasized. One is that there's an objective rather than a subjective approach. So even though it's about the intent of someone, it's not like you put them on an e-meter or a lie detector and see what they really say. You look at what they actually did, and that's how you're gonna make the determination. The other thing, and I can't emphasize this enough, and it's right here in the committee report, but people lose track of it all the time, is that a reasonable expectation of profit is not required. You don't have to expect that you're going to make a profit. You have to have an objective of making a profit. And this allows for things where it's a long shot. I mean, there's a lot of things you can go into, and you can just say, you can have an objective of making a profit, but objectively, you're not going to. Wildcat oil drilling is one of the examples that they use of that sort of activity. So the thing about this is if your client comes to you and says, I'm doing this thing, and my spouse is going to open this gift shop and sell Spanish American War memorabilia, and there's a great market for it. People are really getting back into Teddy Roosevelt and the Rough Riders, but there's a lot more to it than that. We're going to have Admiral Dewey stuff also, and this is going to be great. Well, you might think that particular idea that I just made up is ridiculous, but if your client has a true objective of making a profit, it doesn't matter. So you can guide them and be a great help to them. You don't say to them, no, don't. Well, you could say to them, don't do this. This is ridiculous. Okay, that's a reasonable thing to say. Probably, maybe you'll turn out to be wrong, but if they're committed and if they're sincere, you should be coaching them to take the losses, to deduct the losses, and that's what this is about. Which brings us to Code Section 183D, the presumption. Now, if somebody knows anything about Code Section 183, the hobby loss rule, they know this or some distorted version of it. And the idea of it, is it from an activity in 3 out of 5 years, 2 out of 7 in the case of horses. And by the way, it was a senator from Kentucky who got that little adjustment in. You have a presumption in favor of the taxpayer that they're doing this for a profit. If in 3 out of 5 or 2 out of 7 years. And I'm going to say this over and over and over. It's a presumption in favor of the taxpayer. And the other thing I'll tell you is this whole thing, which people get very excited about. Whenever you read an article about Section 183, you'll see a discussion of this. Probably isn't very important at all, because it like almost never comes up in the case law. Over 300 cases I saw it mentioned once in the 90s. It's just not that important, partially because, well, we'll see why. But let's go in there now. Though the IRS in the Internal Revenue Manual, they mention it. It's like, well, yeah, the first thing they say is, does the taxpayer have losses in 3 of the last 5 years and 2 out of 7 for breeders? If so, it may indicate a hobby. And actually, that's backwards. I don't think that's even right. But it's given this prominence. I had a friend of mine one time. He's got this little business going, and you know, a lot of times with my friends, we'll get talking about their tax issues. That's one of the hazards of being in the profession. And you know, he says, yeah, well, you know, I lost. I've been losing money. I had losses the last 3 years. So my accountant told me 4th year, can't take any losses this year. And I said, well, how much you been losing? And he says, oh, like $300-400 a year. And I more or less decided and said, yeah, whatever. He's not any great harm. But that is just so wrong, okay? Because the thing about the presumption is it's a one-way street in favor of the taxpayer. So it's a one-way street. You got your 3 out of 5, you got your 2 out of 7. There's a presumption in your favor. Okay. It's a very little practical significance because it hardly ever comes up, but it is in fact a something that's just held in favor of the taxpayer, cannot be used against them. Now, the IRS has updated their audit technique guide for activities not engaged for profit just recently. It's 9/7/2021. I don't know if this means that they're going to go after it more, if they just finally got around to it. The last one was in 2009, and this one actually wasn't that different. I mean, as I compared the two of them, a lot of the language ends up overlapping. However, and if you've got one of these cases, you should really read this audit guide, be familiar with it. If you're going up against an agent, you don't necessarily want to mention that you've read the audit guide. You know, that's kind of up to you, and you can't really tell them how to do their own job. There is one thing in the audit guide, though, just this one thing, that if you get an agent who's going on, it's like, well, you know, it's like your clients lost money for 7-8 years. You know, it's like it's 3 out of 5. You know, so I got you, you know, they lost money for 6 years. So, and that's it. I got you. The one thing in the audit manual to point out to them, which is it's relatively early. I'm sorry, I'm not giving you the page number. Is examiners cannot use 183D as the reason for disallowing under IRC 183, even when the taxpayer fails to meet the presumption. The taxpayer fails to meet the presumption, it means nothing. That's it. And it's right in the audit manual now. I'm pretty sure it wasn't that wasn't in the old one as far as I can tell. So they're finally getting this, and it's never been any different. But because it's this rule of 3 out of 5, 2 out of 7, accountants love rules like that. It's extremely objective. You can do a little worksheet and you can show it, and but it's not something that's used against taxpayers. And we'll see that there's people will lose money for 20 years, and the losses will be sustained. I'm going to just gloss over this entirely. There's an election you can make to extend the statute of limitations. Like if you've only been in business for 3 years, you haven't been in business yet for 5 years. There's this elaborate thing about extending the statute of limitations. It's not. It could be used it's something you might do in an audit, but I'm not going to discuss it in this brief introduction. Who are they after? This was discussed in a TIGTA report. That's the Treasury Inspector General for Tax Administration. And they're the ones who kind of audit the IRS. They did a study in which they were saying the IRS isn't going hard enough against hobby loss, and they said, well, here's the type of Schedule C that we think we might want to go after. It's somebody with a $20,000 loss, less than $20,000 in gross, 4 years of losses, and other income of $100,000 plus. That's your profile of somebody you want to go after who has a schedule, who has a Schedule C. So you should be thinking about that with your clients, okay? That if somebody fits that profile or started fitting it, it's like all of a sudden they're making more than $100,000 a year. They hadn't been making that much or whatever, that you shouldn't tell them stop taking the losses, but you have to say, hey, we really gotta focus on, we gotta be prepared for this issue. So, is it just hobbies? There's a lot of things that we'll see here. We got art, gambling, airplanes, movies, horses, lots of horses, anything agricultural, racing, dog breeding. The audit guide, the audit technique guide gives a list of things. I'm not going to run through them all, but acting, artwork, writing, auto racing, gunsmithing. Actually, blogging came up. There was a hobby loss case about blogging, which is relatively recent. I'm sure there'll be something about Bitcoin mining, and that's somebody will figure out how to lose money doing that, I'm sure. Amway distributorships. It's quite a list. Some odd ones on there, like practicing law. It came up. Have not seen somebody who was considered doing accounting as a hobby. That hasn't been raised. Remember, IRS agents are IRS revenue agents are accountants. That's the educational requirement is 30 hours in accounting, unless it's changed. I haven't looked at that recently, but that might be a factor. However, as noted, it's activities not entered into for profit. And even though the committee reports and the whole intent and everything is kind of about hobbies, basically things that people are doing just, because they want to do it, and they make it look like a business. But Section 183 was also used against tax shelters quite a bit in the 80s. There's a large number of cases, and there was a recent case, Prester Olson, which Section 183 was applied to. It was a tax shelter thing with some sort of energy credit thing with a solar lens, where you'd buy this solar lens, and nobody ever figured out how to actually make energy with it or whatnot. It was just a tax credit deal. There's a lot of those things in the in the 80s. So it's interesting, though, that was the first time I saw 183 applied to something that wasn't kind of hobby-like in a way. So I don't know if that's going to be a trend. So, which brings us to the regulations. If you know more than the 3 out of 5, 2 out of 7, the thing that you're likely to know is about the 9 factors. Although I really admire you if you have them memorized, because even after all these years, I still don't. Judge Posner has referred to the regulation as being goofy. The fact when it gets into these 9 factors. In the introduction of the regulation, it says a couple of things. Is no one factor is determinative in making the determination, and it's not intended that these be the only factors. And also, it's not a matter of scoring the factors. It's like, well, there's 9 factors, and taxpayer got 5, IRS got 4, taxpayer wins. That's they say that's not the case at all. No, it doesn't work that way. And that was reemphasized in the current version of the audit manual. Those 2 points. When in the audit manual they go through the factors, at the end of each one, there's this paragraph where they say, well, yeah, you went through this factor, but this isn't the only factor, and you got to keep the big picture in mind, yada, yada. It's the same identical paragraph 9 times at the end of each paragraph saying that. The thing is, the case law does not actually support this. This is not how it works out in practice. If you take the time to look at all the cases, okay, and that's kind of what this is about. But I got to do it a little dramatically. And here's the thing about the factors is most of them, you really can't do anything about it. Okay, you can try. Okay, and I should also mention that the in the audit guide, the factors are heavily, heavily emphasized. The 9 factors, they give them a spreadsheet, a worksheet that lays out the 9 factors. And they say, one of the main reasons why cases get pushed back at appeals is because you haven't documented the 9 factors that well. It's still a strong emphasis in the audit technique guide. But the interesting thing, one of the things about the factors, as a planner, as somebody who's helping your clients, is a lot of them you really can't do anything about it. You can maybe push the narrative a little bit, but one of them is elements of personal pleasure or recreation. A lot of the cases are about things that look like fun. At least, it's like to a 10-year-old. So that's why there's so many horse cases. That's, it's just, boys and girls, it's like, you don't want to be a cowboy when you grow up, you got Black Beauty. It's just, the horses, it's just that, that romance. You will find in some of the cases, people losing money for 20 years doing the horses, and it's like, I don't like horses, I'm just trying to make money, and it's a little implausible. Now, if you're doing a case, you probably want to fight about every factor if you can, but it's hard. It's hard to do that with some of them. Elements of personal pleasure or recreation, a little challenging. The financial status of the taxpayer. This factor is like a gimme to the IRS, because if they don't have income that's worth sheltering, if they don't have income to shelter, you're not having a 183 audit, because it doesn't matter. There's even, they have a worksheet in the audit technique guide where they go through a multi-year analysis of how, what's the return look like with the loss, what's it look like without the loss. It's like, are we going to bother with this? So you will find that there's really nothing you can do about this, because you're not having the audit. Now, oddly enough, taxpayers don't always lose this. Sometimes it's considered neutral, and I have a theory about that, but we'll get to that, because again, you have the amount of occasional profits, if any, which are earned. You'll hear some planners saying, "Oh, you'll try and goose things together so you have a profitable year here and there." Doesn't really come up in the case law. There is the thing, though, moreover, an opportunity to earn a substantial ultimate profit in a highly speculative venture is ordinarily sufficient to indicate that the activity is engaged in for profit. So what a lot of the cases end up being about is the big payday. Yeah, we're losing money, but there's gonna be this big payday. Taxpayers' history of income or losses with respect to the activity. Yeah, this is redundant. Like factors 6, 7, and 8, they're very hard to do anything about, and you'll do it. But except in crafting the narrative, if losses are sustained because of unforeseen or fortuitous circumstances. You'll see this more in the horse, a lot in the horse cases, but the narrative that people will craft is one GD thing after another. We were doing Arabian horses, but the market collapsed and the horse people weren't going to the track so much, so we switched over to paint horses. And there was this hurricane, and we had this great stud horse, and it turned out to be infertile. And it's always, you know, this train of misfortune that you craft a narrative about to explain why you've had losses for all these years. The success of the taxpayer in carrying on other similar or dissimilar activities. I call this a fudge factor, and here's where I'm going to tell you about one of the things that they say in the introduction to the reg is the way it should be, and from studying all the case law, it appears that it is not. They say that it's not count the factors. You know, if it's 5-4, then you the IRS, you're 5-4 in favor of the IRS wins. But that's absolutely not the way that it goes. The truth is that in all the cases, except for one, maybe, I think there was one, where the judge goes through and scores the 9 factors, and some of them might be neutral. There's never a case in which, like, oh, well, that factor, we're not going to consider that factor, so it's 4-4. There's never a 4-4 case. There's never a 3-3 case, ever. Never happens. And the other thing that never happens is if it's 5-4 in favor of the IRS, the taxpayer wins. Or if it's 5-4 in favor of the taxpayer, the IRS wins. The count always aligns. And I think the reason for that is the judges want it that way, and they have these factors that they can fudge. And this is one of them, the success of the taxpayer in carrying on other similar or dissimilar activities. You know, the fact that they've done some things profitably, it could be a sign that, yeah, they know what they're doing, or it could be irrelevant, or that other thing isn't anything like this. So I really think there's a fudge factor, and again, it's you know, you might come up with ways of fighting on it, but there's no there's not a lot of point to it. Expectation that assets used in activity may appreciate in value. This is what saves people in a way in the cases that, in terms of crafting the narrative, that, hey, I'm going to, you know, there's this big payday in the sky. One of the things that will help you make this argument is appraisals. If you're saying, well, I got this thing because I'm doing this business. So this guy, Captain Eddie, he had a rare airplane, and he never got it appraised, and he never showed that he was thinking about selling it. Possibly, if he had done that, he might have been able to win his case. There's a special rule about this in the case of farms, where you're saying, well, I'm doing this farming, we're losing money on the farm, but you know, property's going way up in value, and that's going to bail us out. There'll be a limitation based on if the farming is cutting your expenses for carrying the property, then you can make that argument. But if you're losing money beyond what you'd have to carry, get out of carrying the property, like you're saying, well, hey, I'm paying the real estate tax. You know, I'm growing some crops. I'm paying the real estate tax. It's helping me pay the real estate taxes, even though there's a net loss. But if the losses are going over and above that, so it's not really, so you can just say, hey, you'd be better off just paying the real estate taxes and the insurance and not doing nothing. Then there's that. The other issue, and this is this is more broadly important, is defining the activity. Because one of the ways out of dealing with this section is broadening what you consider the activity to be, so that if you're making money doing some stuff, losing money doing something else, well, it's all one business. It's all one big business. If you can make that case, you can kind of dodge 183 entirely. Time and effort expended by the taxpayer carrying on the activity. You know, if you keep logs, one of the things that they'll mention in the audit technique guide is, well, there's also code section 469, the passive activity loss rules to be considered. So, you know, logs and stuff like that. But the fact that you're putting serious effort into it is a sign. But again, this is another fudge factor. It relates to factor 9. It's like, yeah, he's putting in all these hours, but he really enjoys riding the horses. So it's fudge. Now we're getting close to the real stuff. Expertise of the taxpayer or his advisors. One of the things that comes up on evaluating this issue is you don't want to just talk to experts in the activity. You want to get expertise in making money in the activity, which is often different from doing the thing. And actually, I mean, if you run an accounting practice, you know that this is true. There'll be all these seminars where you go on and it's like, here's how you can make money running your accounting practice, and it's got very little to do, if anything, with being good at doing accounting. But that's what comes up in this factor. So we're running out of room here, which brings us to factor 1, the one factor to rule them all, the manner in which the taxpayer carries on the activity. Now, what is really great about this is that this is something that you can help your client with, and you'll be giving them real value. And also, if you it might convince them to do things that will make your life easier in getting their return done, because it's this factor that does it. And here's the big takeaway on this. All the cases where they go through all the factors, or they go through, including saying some of them aren't relevant. Okay. Maybe one exception. If the taxpayer wins on factor 1, they win the case. If they lose on factor 1, they lose the case. And that's why I have this theory that the other factors are fudged a little bit, because the judges because despite what the regs say, the judges don't want to have it's 5-4 in favor of the taxpayer, but the IRS still wins. That isn't, that just hasn't come up. But this factor, if you win on this factor, you win. If you lose on this factor, you lose. And this factor is the one that you can actually affect. You can help your client, you can coach your client so they're in a position to win on this factor. And oddly enough, if they actually go through and do this, maybe they'll actually start making money, and it'll become irrelevant. It's to carry on in a business-like manner. And what's the first thing in a business-like manner? Complete and accurate books and records. So who's going to help the client keep complete and accurate books and records? Who's going to tell them how to do that? This is real value that you're in a position to provide, and it helps them win. One thing that comes up a lot on this is not only do those books and records have to be there to support tax deductions, they also have to be used, if possible, to make decisions. So you want to do it and just say, hey, look at this, your gasoline expense is up. What can we do to bring your gasoline expense down? You want to show that the keeping of the records is being done to improve profitability. The other thing is that you're doing things the way people who do this profitably do things, unless you have some theory as to why you've got the new breakthrough method that's going to overturn the industry. If you do, if you find out what people who do well do, and you do the you do those sorts of things. The other thing is a change of operating methods, and adoption of new techniques, or abandonment of unprofitable methods. If you have 20 years of losses and you want to win on Section 183, you have to show that you have not been making the same mistake over and over. You have to show that you kept on making new mistakes. That's a key thing in the narrative. It's also obviously a sensible thing. It's, the saying about insanity is repeating the same behavior and expecting a different result. So, complete and accurate books and records, carrying on substantially similar to profitable undertakings, change of operating methods, and the other factors, the other two that kind of work their way in are business plan and advertising. I will say that on business plan, and business plan is mentioned in the audit guide. But one of the things they say is well, it could be in the guy's head. Okay, it doesn't have to be this formal written down thing. And also in the courts, there's been a little move away from the business plan as being super necessary. They in Susan Crowell case, she's an artist, and it's like you don't have to be an economist to know how to sell art. And it's like one of these days, one of her paintings is going to be worth a lot of money, and she'll make it. And it's really you, if you decided, hey, I'm going to do this risky thing. That's pretty much it. You can't really really change that. There's been comments on this in some of the case law. But again, it's better to have it. What I would say you should do with your client, if you can sell them and saying, hey, look, you're doing this thing, You got the gift shop there. You know, you're a thoracic surgeon. Your spouse has a gift shop, and they're losing $35,000 a year. You're making $700,000 a year. You got that $35,000 a year loss going. You know, you both think that there's something to this. What is it that you're going to do? I believe that if each year you go through that business with your client and write all this down and say, okay, here, you lost money this year. What are you going to do different in this coming year so that you're going to make money? And you write that down. And hopefully they do it. And whether it works or not, the next year you're going to say, well, you tried raising your prices and your volume went down and your volume collapsed. So you lost money again. What are you going to do different this year? And that's, I think you can create that story, craft that as the clients are going. You'll be providing them with real value. It will be there in the permanent file when the agent comes in with all the questions. You'll have the answers. Advertising also comes up as a sub factor in this area. So agents are still focused on the factors. Okay. The audit guide gives the most frequently cited reasons, alternative arguments not addressed, disallowed expenses were not verified as to whether they were deductible or personal in nature. That ends up being an issue in a lot of these cases. Sometimes, you know, to be frank, sometimes people are just trying to, you know, they want to deduct everything. Multi-level marketing people are great for that, because it's like, hey, you got a multi-level marketing scheme. Well, anybody is a potential downstream for you. So, you know, you're doing business all the time. Always be closing. But the nine objective factors in the regulations were not addressed. So there's pressure on the agents to address the 9 factors. You're gonna have to deal with that. So that's still now on this brief presentation. I'm gonna be closing very soon because what I discuss now and we'll be discussing in a longer seminar is the case law. Nearly 50 years of case law still relevant. In the audit manual, just out, Section 183 was part of the Tax Reform Act of 1969, which we already know that, you know, Woodstock and the moon, and the regulation were issued in 1972. Both have remained substantially unchanged. So the entire body of case law of nearly 50 years remains relevant today. And I'm just going to discuss one of those cases with you. And it's an oldie, but it's I believe it's extremely important, and it should be at the top of your deck. I think of going into an audit where I'm representing the taxpayer as like the game Magic the Gathering. Now, if you've ever played, maybe when you were a kid, you might have played the game called War, although maybe somebody renamed it. But you split the deck of cards into two. You each have 26 cards, and you start turning over cards. And whoever has the higher card on each pairing wins. And then some sort of thing for ties. And you just go go through this until one of you ends up with the whole deck or something like that. Magic the Gathering is much more complex. And what is intriguing about it is there are many thousands of different magic cards. And what the key is in the game isn't so much skill in playing the cards, although there's some of that, and I'm terrible at it. But it's, you get to build your deck out of those thousands of cards. Of course, you got to obtain them, which, you know, that's can be financially burdensome, but you get to build a deck out of these many cards that possibly have, and your opponent builds their deck. And it's a little like Erwin Rommel said that before the battle, the quartermasters have determined the outcome of the battle before a single shot is fired. And I think it's that way with Magic the Gathering. Like the person who builds the better deck will tend to win because the cards are complicated. And you know, you'll put down a card, and this is my magic spear, and I'm going to stab you with the magic spear, and oh, but I got the magic shield, so that's going to electrocute you, or some crazy thing like that is the way the game goes. When you're going into an audit, you want to have the better deck, and there's unlike Magic, where sometimes there's a limitation on how many cards you can have on your deck. There isn't anything going into the audit. If you're going into the audit and all the agent has is the audit technique guide and maybe some section of the Internal Revenue Manual, well, you're going to have those. They're going to be in your deck. The particular pieces, like it's you can't use 183D, but you're going to have cases, and what you want to have is the winning cases for the most part. And the agent is going to say, you don't have a business plan. They're going to play their, you don't have a business plan card, and you're going to play your Susan Cryle card. Susan Cryle didn't have a business plan. You don't have to be an economist to know how to sell art. And that's the, you know, when you'll have more car if you have a better deck, you're more likely to win. And of course, having your client be prepared, having the narrative, those are additional things in your deck. But I'm just going to talk for this presentation. I'm just going to talk about one case, and you will have to sign up for the whole course if you want. If you want more than that. And our hero is Spotswood W. Robinson III, DC Circuit, and he wrote some very important civil rights opinions. At the moment, I don't remember what they were, but he was. But for tax practitioners, he's our Section 183 hero. Okay. Because he did the DC Circuit opinion in the case of Maurice Dreiser. And Maurice Dreiser was what you would call a Trustafarian. His family, going back to his grandparents' generation, had owned the most famous jewelry store in the Metro New York area, and they did very wealthy, and they got out at the right time apparently, and just had a lot of money. So he just was a trust fund beneficiary. That was his main career. but he kind of became, he graduated from law school, never practiced law, but then he kind of got into doing some sort of show businessy type stuff. He had this radio thing that became the inspiration for the show The Price is Right. But his main thing was doing stuff to help people eating and drinking. So he wrote a book about dining companion guide or something like that. It was going out to the restaurant, and he did a recording explaining how to make cocktails. He was he felt really bad for the steel workers in Pittsburgh because they had to work so much in the mill, they didn't get enough time to drink as he did. His big project, though, was the search for the perfect steak. And he was going to write a book about his search for the perfect steak. And he was a bit of a showman. He'd get on radio shows and that type of stuff. I actually, when I started studying this case, I remembered hearing him one time on the Barry Farber show. He used to come on WOR after Gene Shepard. He had this whole scientific thing about the perfect steak. He'd go to a restaurant and he'd weigh the steak and he'd test it for salinity, and it was all very scientific. And then the big test was he would use a golden butter knife to make sure it cut. And if it didn't cut, that was it. And if the restaurant did a pretty good job, he'd award them with one of his golden butter knives. And he traveled the world doing this for 27 years. He had an assistant who he later married her, and just went around the world trying, working on this book, and lost a lot of money doing it from 1967 to 1976. Lost $259,000. And remember, you want to multiply that by about 7 to put it into contemporary terms. He was audited for 72 and 73. So this is like among the earliest Section 183 cases. Deficiencies of 39,000 on losses of 50,000. So marginal rates were much higher back then in the early 70s. Because remember, he wasn't sheltering the salary. He was sheltering investment earnings, which were taxed at a higher rate, different days. And the tax court more or less says, "This is ridiculous. You're not going to make any money writing a book about the perfect steak. This is just absurd." So he appealed. Went up to the DC Circuit because he was an expat. And this is where Spotswood Robinson, it's in the committee reports, but basically the tax court had said he didn't have a bona fide expectation of profit. Okay. And Judge Robinson said, no, that is not the correct standard. It is the objective, not the expectation of making a profit, that is to govern determinations. And this, you've got to emblazon this. This is the key to 183. If the objective is there, you're entitled to take those losses, and the objective is shown by objective criteria in the different sense of the road. So that's the key. Now there's there's a large number of other cases that I'll be addressing on this Friday with the Boston Tax Institute, and the full seminar will be available from the Boston Tax Institute and will include 4 hours of credits, CPE credits. So hopefully you'll consider. If not, I hope this has been helpful. By the way, good old Theodore Dreiser, the one thing you don't have to mention this to the agent when you bring this up is it went back to the tax court, and the tax court said, "Oh, we're sorry we used the wrong standard, but you know what? You still lose." Still, it is a good precedent. Thank you very much. I'm Pete Riley, your Tax Matters partner, and I'm signing off. Evie,
Yes, that's it.
still the recording. Stop recording. Okay.